Hey guys, welcome back to the channel. Today I want to go over the Silver Bullet trade setups for June 7th. That's starting in the London session from 3 a.m. to 4 Eastern Time. This is what you could have seen. So we start off with a short-term low being taken. And then we look up and we see a fair value gap right here. Okay, and now these purple lines, dotted or dashed lines, are the new week opening gap. So this fair value gap is right in the middle of that, in between those two. And you could have taken a trade when you got in here. Now what's supporting it is the fair value gap and the new week opening gap. So once we cross through it, it's going to hold. It's going to act as resistance. So that's going to be a good trade right there. You take your trade right there. Your stop loss would be above this high, one tick above. You'd aim down here for 5 handles. So you'd get in right there. And when you look down for a draw on liquidity, you'd see on 15-minute time frame there is a fair value gap right there, which we'd be aiming for, and it's 7 handles away, 7 points away. It does touch it right there. I don't know if it continues. Don't know if it continues down there or not. I think it touches it and bounces away. But that was your draw on liquidity. There was another one below that for you could potentially get 10, but this is where you got your 5 on that one. And then you also see that there's a fair value gap right here, so you could also get in. You missed that first entry, came down, you could also get in right here. You see that there is a short-term low being cleared. Price comes back up. Could take your trade right here. Stop would go above these candles right here. It's less than 2 handles stop loss. So you'd get in right there. And then price trades down, hits your first target right there, and then hits your second target right there. Those are your 2 Silver Bullet trade setups for London. Basic structure, fair value gaps, nothing really too fancy. I'll show you this right here. And no, we did not take liquidity first. You can see that we're on a downtrend here, and you have no structure break to market structure shift to show you that you're going to go long. So you're just continuing to see PD array is being held, acting as resistance. PD array is being respected. I mean, if you want to dive in deeper in here, you can also see that there is a volume imbalance right here. It's a volume imbalance right there. You see it being respected. They come to the top of it. It's being respected. So you're definitely in a bearish cycle. And so taking this is not chasing trades. It's following price action. You're following your PD arrays. That's what happens. So you want to see a market structure shift. You're not going to get one here, but you're going to see short-term lows continuously be taken out. One gets taken out here, one gets taken out here, one gets taken out here, one gets taken out here until it finally reaches your target. So you still get all these short-term lows being taken and all these higher PD arrays being respected. That's not chasing price, that's following price action. So that is your Silver Bullet session, your 2 trade setups for June 7th. Now let's go over to the AM session. Okay, now we are in the 10 o'clock to 11 a.m. Silver Bullet session, the AM session. Now a couple things I want to show you about these lines here. The purple lines are those new week opening gaps for June 2nd and 4th. Okay, this dark dashed line is the 8:30 opening price, and the blue dashed line is the midnight New York time. So the first thing we see, looking back, see where the price was heading towards. There is a higher time frame fair value gap. It's also on the 1 minute. It's also on the 5 minute. Right in here, that's where it was aiming for. So it came up, tapped into that. You can see a short-term high being taken right here. Then we come down, we see a market structure shift. Why is this a market structure shift? I always get this question. Well, for me, a market structure shift is the swing low or high that took out the swing low or high, right? So This is the swing low in this instance that took out the swing high. This is the market structure shift. This right here, if you look on a line chart, would be a pullback. This would not be, for me, would not be the market structure shift. Even though it is a swing low that took out the high, this is the lower one right next to it, one candle away. So for me, I want to see this broken. This is just too close. I want to see a little bit further. Either way, it's kind of semantics. You know, you get a pullback, but you don't get a pullback until after it clears this one too, after this one. So it's not like you had a pullback here anyway. So then we come see the charts. We see a fair value gap right there. So price came down, broke structure, comes back up. There's a fair value gap. We're not in our time frame. Can't take it. Price comes back down, comes back up. Still can't take it. Now if price comes in it, what else do we see here? We also see this order block right here. This is an order block. So price comes back up, hits the order block, comes the consequent encroachment of that order block, or really close. If we threw the fib, it'd be really close to that. Let's throw it on here just for fun. There it is. There's consequent encroachment, the red line. So it came right up to consequent encroachment of the order block. Order block, very powerful PD array. And it stops dead in its tracks. You take your trade, right? So if you took your trade right there, you could use the fair value gap like we were showing you there. So the start of the order block. And where does your stop go? For me, it goes above the order block. But since we're using the fair value gap, we'll go one tick above this, which is the high. So I went one tick above the high. Okay, it's all how you want to trade. This is just how I trade. There's just other things that would add into why I would take a higher stop, just to make sure that if I'm wrong, it's going to take the high, and so then I can possibly get in again because now it just took liquidity. So for me, that's where I put my stop. You take a sell right there, and where would be your draw? Well, the first target would be these relatively equal lows right here. And that's, 8 handles right there. That would be your 10 right there. So ICT says you got to have 10 handles minimum. You actually get it later on. So we get taken out right there. All right. So looking back here, could you have pyramid entried into this? Yes or no? Well, there's another fair value gap right in here. So you could have gotten another entry right here. Got a short right there. Where would your stop go? It'd be above here. So that's 5.5 handles, 5 1/4 handles, 5 handles. 5 handles is right above that, so it would be 5 handles. And shoot for 10 would be this new week opening gap target. They're a good draw of liquidity. So there's your 10 handles for that. Get in right there. Your draw of liquidity could be down here if you wanted to. After that target would be here. Your first target would obviously be, well, here's your 5 handles right here. First target would be this, second target would be this, third target would be that. That's how you'd stage it. So if I was taking this trade, I'd be getting in, my first target would be here, first partial. If I had more, my second partial would be here, third partial would be here, and that'd be my runner, and just let it go and trail my stop close so I can maximize my profit potential. There's nothing worse than I hate having it come all the way down to here, let's say, and then come back and take me out. I don't like losing all that potential profit. So me, I trail my stop, trail my stop, trail my stop. If I get taken out, I'm still taking some profit. So, and that seems to be working pretty well for the trailing drawdown on funded challenges. So you'd be getting out right here on this candle. It eventually does hit your target. So there are your 2 trade setups for the AM session silver bullet hour. Let's move this down so it's a little bit easier to see. Take these off so you can see how it was with the arrows. And that's the silver bullet AM session. Now let's go to the PM session. Alright, so this is the PM silver bullet session on June 7th. 2 to 3 p.m. Eastern Time. This dark shaded area is 2 to 3 p.m. So the first thing that we see is a short-term low being taken out here, and then we see a market structure shift all the way up here. Now, yes, We could have said market structure shift here. There is a fair value gap. That's great. But this is the afternoon trading. We're talking about the silver bullet hours. So this would be a good setup right here with this fair value gap, and take your trade. Would have been great. We didn't get there because we're waiting for our rules at 2 o'clock. Okay, and so why do I say this is the market structure shift? Because this is the swing high. That was the catalyst that took out the swing low. Okay, and since nothing else in the silver bullet hour, this is the highest high that was just taken, so we're going to call that the market structure shift. So price comes in, and we see, look left. Once we have this, we look left, there's a big fair value gap right here. So we mark that fair value gap up. Now this dark dashed line is the 130 open price. So just to let you know what that is. Drawn liquidity, if we're going to go long, would be all the way up here. And I'll just move this over just a little bit so you can see where that's the high there. You can take your trade as it comes down, and that would be your drawn liquidity. Your stop would be below this candle here, 1 tick, which we are, so that's 3 1/4. You need 6.5 handles or 6.5 points to be 2 to 1 or 1 to 2, and you get it. Okay. You don't get quite 10 handles. That's what you could have shot for, but we didn't get it, so that's what it is. So you'd buy it there, and then as the price is coming up, you see a fair value gap right here, and then you got out right there. If you didn't take this trade, you're seeing as your price is coming down, it comes down, comes up, comes back down into here, and it respects the consequent encroachment. You're thinking, okay, I still haven't taken out this high. You could be getting into a trade. You take that trade. And so you get in, it comes up, doesn't go to 60%, so we're not break even, we're not moving our stop, we trust our analysis, and we get taken out. Got in here, and we took a loss right there. If you would have drawn your fib from this high, which was our target, down to here, it's above equilibrium, so it's in a premium. Probably shouldn't have taken the trade, but a lot of people would have taken this trade because they're still aiming for this target or this high up here, and that's 5 handles. This would be 5 handles right there. So you have at least 7 handles, now 6 1/4 handles to get there. How else would you have known why not to take that trade? So I'm going to take this off real quick. I'm going to leave the up and down arrows just to show you. So and then let me take this fib off real quick too, so you wouldn't, how to avoid this loss, okay? Well, you could have seen it a little bit differently, right? You could have seen this taking out a short-term high, so it grabbed liquidity. Liquidity is resting above this because that's one of the major swing points of right here. Came up, took that liquidity out. We get a market structure shift right here. At least that's what my ICT calls it. For me, it would have been down here, but he does say this. He's called this a market structure shift before. I call it a short-term low being taken. We'll call it whatever it is. It's a swing low. It's taken out. It comes up. Taking that out. We look left, we see a fair value gap right there. We see another fair value gap right there. Price does come up into that, respects that fair value gap. Our stop goes above that handle. Where do we target? Well, we'd be targeting for these lows at that point. So you'd get in right there. Your drawn liquidity would be these lows, and you would get out there, and that is 5 handles. Your target was, 10 handles right here. Right there, 10 handles. So I guess the way to avoid this trade setup is watching price action as it came down here and pulled back. You're probably not entering right at that point right there. You're entering down here as it comes into the fair value gap. I don't know if you'd get triggered in there or not, but as it came back down, now you're saying, wait a minute, hold up, a swing low has been taken. Whether you want to call it a market structure shift or a short-term low, either way, a swing low has been taken out. So now you need more confirmation. You want to have it come back and go past this swing high to continue going long. It doesn't. It comes up and it stops. It stops there. Well, it stops here. stops on this candle. This candle covers the fair value gap. You got to be looking left. You got to be, is this an entry to go short? Has there been a change in structure? According to ICT, there has been. Okay. If you've used the fib another way, like I showed you, from here to the high here where our target was, this was in premium. So we're not looking to buy in a premium. So that would have stopped you if you pulled the fib. Okay. So there's a few ways to avoid the loss. Those are your Silver Bullet sessions for June 7th.